discriminate, and how regulators, like the EU with its AI Act, are stepping in. AI agents are running the show in banking. From approving your mortgage to setting your credit card limit, they're making decisions that affect your life. By 2025, over 70% of banks use AI for lending, per McKinsey reports. That's massive. But here's the problem. These AIs can accidentally favor some groups over others. Think race, gender, or even where you live. Regulators are cracking down, with laws like the EU AI Act pushing for fairness. Why is this trending? Because fair loans mean fair chances for all of us. Let's break it down. So how do AI agents decide if you get a loan? Imagine you apply for a car loan. The bank feeds your data, income, credit score, job history, into an AI model. This model, often machine learning, analyzes billions of data points to predict, will you repay? Unlike a human, AI processes huge data sets instantly. Big banks like JP Morgan use AI to check not just your credit score, but also spending habits or even job stability. Here's the simplified process. 1. Data inputs, your credit report, bank transactions, sometimes even social media. 2. Pattern recognition, AI spots trends like steady income means lower risk. 3. Scoring, you get a risk score, say 0 to 100, higher score, better loan terms. 4. Decision, approved, rejected, or offered a pricey rate. Banks love AI, it's fast and cheap. A 2023 Deloitte study said it cuts lending costs by up to 30%. But if the data's flawed, so is the AI. That's where bias creeps in. Let's dive into that next. Now the big issue, bias. AI agents should be neutral, but they learn from data, and data can reflect past inequalities. If banks favored certain groups historically, AI might keep doing it. For example, if men got more loans than women in the past, AI could see men as safer. Here's why bias happens. Flawed data. Historical lending data often embeds discrimination. Proxy variables. AI uses things like zip codes, which can tie to race or income. A 2020 study by UC Berkeley found black borrowers faced 6% higher interest rates than white borrowers with similar credit. Opaque models. Some AI systems are black boxes. Even banks don't know why they reject you. Industry insight. Posts on X show fintech leaders worrying about bias lawsuits, with banks like Citibank investing in fairness tools. A 2023 Federal Reserve report flagged that 15% of AI loan denials lacked clear reasons. That's a problem when fairness is on the line. To see how this plays out, let's look at real cases next. Let's get real with cases where AI bias in lending made headlines. These stories show the stakes and what's being done. I'm sticking to cases with solid sources so you know it's legit. Case 1. Apple Card Controversy, 2019. In 2019, Apple Card, run by Goldman Sachs, got slammed for giving women lower credit limits than men. Tech entrepreneur David Heinemeier Hansson tweeted on what's now X that his wife got a limit 20 times lower than his, despite her better credit. The story went viral, sparking a New York regulator probe. Goldman said their AI was blind to gender, but critics pointed to data issues, like spending patterns flagging women as riskier. The fallout? Goldman retrained their model and faced ongoing scrutiny. A study by Oberlin College and MIT, published in 2020, found AI-driven lending platforms charge Latinx and Black borrowers higher interest rates, up to 8% more, than white borrowers with similar risk profiles. The study looked at fintechs using alternative data, like education or job history, which unintentionally mirrored racial divides. Regulators took note, pushing for bias audits. This wasn't one bank, but a trend across AI platforms, showing how widespread the issue is. ProPublica's landmark report exposed how early AI lending tools, like those used by online lenders, disadvantaged minority groups. Their 2021 update showed some platforms still gave worse terms to Black applicants, even when controlling for credit scores. The issue? AI relied on proxies like zip codes, which correlated with race. This led to calls for transparency laws, influencing today's regulations. It's a wake-up call that bias isn't new, it's evolving. These cases prove AI bias isn't just theory, it hits real people. But they also show change is possible. Let's talk about how regulators are fighting back. So, how do we fix AI bias? Regulators are stepping up, and the EU AI Act is leading the charge. Rolled out in 2024 and enforced by 2025, it's the world's toughest AI law. Here's how it tackles lending. 1. High-risk label. Lending AI is high risk, since it shapes lives. Banks must prove fairness. 2. Bias audits. Models need testing to catch discrimination before loans go out. 3. Clear explanations. Rejected? Banks must tell you why. No vague AI said so. 4. Big fines. Mess up and it's up to 7% of global revenue. That's billions for big banks. The US is moving too. The Consumer Financial Protection Bureau demands adverse action notices for loan. Travis, rejected? You get a reason. A 2024 CFPB report pushed for AI transparency, citing cases like the Oberlin study. Globally, places like Singapore are testing AI sandboxes for safe testing. That's a wrap. We explored how AI agents assess loans, how bias, like in the Apple Card mess, can derail fairness, and how the EU AI Act and other rules are fighting back. We dug into studies showing real disparities and shared industry trends, like explainable AI taking over. Subscribe and tap the bell for more AI and banking scoops. Maybe fraud detection next? Share your loan stories in the comments. I read them all. Thanks for watching. See you soon.